Welcome to Bloomberg's ETF IQ. I'm Sonali Basak, in for Katie Reifeld today.
And I'm Matt Miller. We've got a lot going on. Rates are ripping higher. The dollar is strong. You can buy 145 yen.
We're going to talk about all the volatility under the surface because things look smooth, but they're not, Matt.
All right, let's get to the biggest stories in the more than $10 trillion global ETF industry. In just moments, we're going to be speaking with Bryon Lake of JPMorgan to discuss their ETFs and how active management can help investors navigate the uncertain environment.
And with fixed income ETFs just booming, we're going to speak to Jerome Schneider of Pimco on its newly launched ETF BLITZ, that is BILZ.
And Bitcoin ETF candidates got another dose of disappointment when the SEC delayed its decision Friday, but the next deadline is just weeks away, so we're still focused on those ETFs.
And as always, we're going to talk to Eric Balchunas first of Bloomberg Intelligence. He is with us looking at the flows.
Thank you, Sonali and Matt. The flows in the past week are best described as weak. They were real strong all summer. The past 2 weeks, they've really died down. Yes, SPY is at the top, $3 billion, you like to see it, but look at the 1 month, still -6. The total flows at the top, 4.3, that white number, that's low. ETFs typically take in 25 billion a week, and you can see their IVV taking in money. And USMV, interesting, that's the minimum volatility ETF from iShares. That had gone away for a couple of years, but I think you're going to find more ETFs like that on the leaderboard as people look for equity exposure, but without this sort of overweight to mega caps. Let's look at the outflows, and you can see why that number for the total is so low. It's because of the Qs. 4.2 billion out of the Qs, that is a ton. Remember, the Qs they've been rallying all year. It's up 37%, and the market's getting a little tired, and I think it's going to look for things that to spook it, and the trading crowd is going to really leave quickly, as you see here. And so you look down here, EM also, and small caps IWM. So with that, let's look at the flows into domestic and international equity ETFs for the past several months, right? So remember, they were pretty weak early in the year because people like the yields in money market funds and bonds, but then they started having really big returns, and people were like, oh, let me go over the equity market. And this summer, look at how thick the flows were into domestic equity and international. But look at August, nothing, right? Nothing. It's netted out to zero, right? So a complete collapse. So the performance is shaky, Sonali, Matt, and the flows are now following it.
Yeah, ETF investors seem a little bit late to the party this year, no matter where you look. Eric, let's talk about that right now with Bryon Lake, Global Head of ETF Solutions over at JPMorgan. Bryon, thanks for coming in. Glad to have you in the studio. What do you think of the flows?
Yeah, no, Matt, I think when we look at what's happened in equity markets, as Eric just talked about, you know, they surprised everybody. They caught a lot of people off sides. Coming off of a tough 2022, you didn't expect the NASDAQ to rally by 36% the way that Eric just pointed out. You know, what I think is interesting is how the flows have been continuing to trend towards active. In fact, the last 2 weeks, we've seen active outflow passive in the ETF space. And I think that's particularly interesting on the fixed income side, which I know we're talking about a little bit as well today. I think of active and passive like I think of a black and white TV and a color TV. There is so much more that a color TV gives you with that picture, and that's like active fixed income in my mind.
I'm very curious about what people want, because if you look at, for example, the NASDAQ Equity Premium ETF, it is so heavily loaded. You're getting essentially NASDAQ plus extra Big Five, if you will. So what are the people asking for when they're looking at exposure, especially in big tech, where interest has certainly been coming back?
Yeah, big tech has led this rally, but I think what we're going to see is an interesting kind of next couple of months going forward. And I don't think about the macro as much as I think about the individual investor. What do I do with my money now? And that's why I think JEPQ, JEPIC is a really interesting play right now. It keeps you in equities. But it gives you this covered call option overlay where it's still yielding north of 10%. And not a lot of people know this about JEPIC, but it actually incorporates an AI component to the investment process. We all know AI is important, and it's going to be a big part of what we're all doing. But the data set that goes into that is so important. And we have 40 years of history of all of our analysts at JPMorgan, and then we apply generative AI to do that, and it's incorporated as part of the JEPIC story. And I was here last time, and I suggested that we look at JEPIC versus JEPE. And in fact, JEPIC has had more inflows in July for the first time ever than JEPE did.
So let's talk about this. Your color TV, I will say, though, yes, but typically the difference is active got cheap. You know, JEPE's a great example, 39 basis points. Bills later is 14. We're going to look at that one. So I think active got cheap and the money started to follow. And I agree, there's a wide spectrum now of interest in ETFs. JEPE, okay, obviously the fastest growing active ETF of all time, beat ARK, took in more flows. But if you look at the flows, they're kind of starting to die down. You're seeing outflows occasionally on certain days. It's underperforming the market. And I guess the question I have is how much more can this thing go? Because you saw some of the returns. What you give up in JEPI is a melt up. And we had a melt up. Yet, the flows are pretty good considering that. But talk a little bit about how much more JEPI can go from here.
Yeah, so a covered call strategy is always going to give up some of that upside if you have a straight up market. And that's basically what we've had for the first half of this year. Now, the question I would ask investors is, do you think we're going to have a straight up market from here till the end of the year? Or do you think we could go sideways or potentially has some risk baked into this? And so, if you don't think we're going to have a straight up, then JEPI does still play a really strong part of the portfolio, JEPIC as well. So I think that you can continue to see that grow. Look, JEPI is closing in on about $30 billion in assets. In the grand scheme of things, like all funds, there's still plenty of room. We've seen funds get to be mega funds and then mega funds, right? I mean, how big is SPY at this point?
So do you think, when Eric showed the chart at the top of the show, and we saw ETF investors getting into stocks in June and July, they're late to the party. Why the disconnect in the ETF world versus, the cash trade?
Well, I think, first of all, you had a really challenging 2022. You had an aggressive Fed that was raising rates at a very rapid pace. And I think that there was a lot of investors that were caught off sides. Don't forget, ETF investors cut the entire spectrum of investors, from individual retail on up to some of the most sophisticated investors. And so when you look at the flows, there's going to be a lot of information coming into that in that way. I think about active fixed income right now. We've got a short core plus strategy managed by Carrie Fitzgerald, who came up with the black and white and color TV thing. Yield to maturity on that is 6.5%. with a duration of 3.5 years. So your yield to maturity is kind of what your annualized return you think you might get. Well, we know what the equity risk premium is. It's about 6%, right? And so if I can get that in a safe fixed income portfolio, maybe that's where I should be.
What's the ticker? What's that ETF ticker?
The ticker is JSCP, JPMorgan Short Core Plus. And we think that that's a really interesting thing to look at in this environment.
I want to go back to a point you were making about if you think the market is going sideways or if you think that we have a leg down from here, how much are you seeing investors looking to hedge, and how much demand do you expect that to get over the next 3 to 6 months? There's a lot of kind of uncertain events in the market.
Yeah, hedging is an interesting question because, as we were just kind of talked about, are they hedging, or are they going to look at it as an opportunity to deploy some of the cash that maybe they didn't get a chance to in the first half of the year? And so, that would be the JEPI, that would be the JEPIC kind of trades where you do have that covered call that can protect to the downside. Remember, in 2022, JEPI outperformed the S&P by 16% because it was able to protect to the downside. So if investors are nervous and they want to kind of get some of that income with some of the downside protection, maybe those are the types of strategies they'll look at.
Let's talk international. BBEU, you guys put a ton of money. You rotated into it in your models. It was leading the flows, and then you've pulled some out. And international really was had a good run for about 1.5 years there. And then the Qs just take over. They got that special something in American innovation, I think, that you don't get overseas. Will we see a reversion back to international now that there's such high returns here? Or do you think, I guess in other words, are you going to go back into Europe or international or stay to the U.S.?
Yeah, I can't speak to specifically what we're going to be doing in the models, and certainly we've seen BBEU used to great effect. That's how some of these ETFs are built. You tactically go into it and you take some performance, and then, as you were talking about earlier, maybe you take some gains. We do think the international space is interesting. As you know, we've got the largest active equity strategy that's XEM, so JIRE, J-I-R-E, which is actually a conversion strategy that we brought over. It's $5.5 billion. This is kind of a low tracking error type strategy targeting kind of 1% alpha above and beyond its benchmark. And so I do think that there's a really interesting play there. Maybe we've got a strong dollar and that could soften a little bit, which could also help some of the international equities as well.
So real quick, you guys are the 7th biggest ETF issuer, but you are gunning for number 6, which is First Trust. First Trust has kind of had a flat year, only $3 billion in flows. You guys have taken in $25 billion or $23 billion, but you're $25 billion behind them. Once you pass them, the next step is the big 5. I bet Athanasios on my team that you would pass them by the end of the year.
This is the wager.
Yes.
In the office.
Am I going to win this bet? It's $25 billion away.
I appreciate the vote of confidence on that one, Eric. What we're focused on, and this is obviously how I'm going to answer that question, is serving our clients well. And if we keep doing the things that we're supposed to be doing, fiduciary active management, serving our clients, they will entrust us with their money, and we'll see if that happens.
That's the best you can do.
That's the best I can do. It's all I can control.
Great
Eric
having
likes
you.
to double down bets, so it's unfortunate.
Serving our clients. Everybody says that.
Yeah, but you got to do your job well if you want your clients to keep coming back with more money.
Yeah, our job is help investors meet their financial goals. That's our role in that, and we're focused on that every single day.
Bryon Lake of JPMorgan, thanks very much for coming in the studio. Coming up, the SEC still deciding whether or not to approve the ARK 21 shares Bitcoin ETF filing. Here's ARK CEO Cathie Wood and what she believes will happen.
I think the SEC, if it's going to approve a Bitcoin ETF, will approve more than one at once. So then, again, because most of these essentially will be the same, and it will come down to marketing.
Welcome back to ETF IQ. I'm Sonali Basak, and it's time now for the ETF Brief, where we're going to highlight stories and trends that caught my eye. We're going to talk about the short volatility trade first, because if the VIX looks a little calm to you, it's the calmest since 2019. Underneath the surface, you have a lot of people selling options, going short volatility, and there has been a 60% surge in assets in these types of ETFs this year, according to Global X. So take a look at that and keep an eye on it for the rest of the year if you think things look a little calm out there. I also want to take a look at corporate bonds, because if you take a look here at LQD, the shares outstanding were just booming through 2020 as corporate bonds lifted back after the COVID crisis. However, they have really slumped since then, but they are regaining some shares ever since you saw equity market really start to hit the top here and investors fly back into corporate bonds. Lastly, I want to talk, Matt, about BITO. This is the first Bitcoin futures ETF out to market, and take a look at how it's done since then. If you took a look at the first couple of days, assets surpassed $1 billion, the fastest ever for an ETF. But since then, they had to go through 2022, jumping back this year just in time for the discussion around the first ever potentially Bitcoin ETF approved by the SEC, but we haven't seen it yet.
Let's talk about that right now. Sonali Basak. We are going to bring in Bloomberg's Vildana Heinrich to talk about this. She wrote the story about it, the delay, the punt, as it were, from the SEC. So we were expecting a decision, today, right, on a Bitcoin filing, and they've pushed it forward.
We were expecting a decision. It was technically by Sunday,
okay,
so
right.
A lot of people were expecting that we would hear back from the SEC by Friday. I think it was widely expected to be delayed. The SEC has a certain period of time during which it can delay, reject, or approve a filing, and a lot of analysts, including at Bloomberg Intelligence, believed that the SEC would delay because, as one of the analysts said to me, why not? If they have the time to delay, then they will.
Which one was this? This was the 21 shares?
The 21 shares, that's right.
But there are so many physically backed Bitcoin ETF filings out there that it's hard to keep track of all of them.
So what happened with the 21 shares ARK filing was that they had a filing in the past. They refiled in April and sort of put themselves in what they said was first in line. Since then, obviously, we've had the big BlackRock news, the big BlackRock filing that sort of shook things up a bit. And then, any number of issuers coming in after that, Invesco, Fidelity, WisdomTree, et cetera, et cetera. So there's a lot of people, or a lot of issuers competing for.
With the flurry of filings, is that part of the reason the SEC is taking more time? There's a sense, as Cathie Wood has been saying, that there could be a number approved at one time, and that could prevent what you saw with BITO, just one issuer getting a ton of flows and the rest kind of being left behind. Does the SEC have an incentive to level the playing field here?
That's a really interesting point, and we don't quite know how it's going to play out in terms of whether or not the first issuer that files gets to go first, which is something that we did see with BITO. So there are other Bitcoin futures ETFs, and you can't compare them because the assets just aren't there as much as they are in BITO. I think BITO has something like $1 billion in assets, around $1 billion. The others are something like 30 million or 50 million. So it really doesn't compare in that way. And so there is a thought out there that potentially the SEC might not want to have that same type of thing happen again. It's just a theory, maybe something that we just like hear on Twitter, so we'll see really how it plays out.
All right.
All right. Thanks to Bloomberg's Valdana Heinrich. Thank you so much. Still ahead, we're going to drill down into ultra-short government active ETF with Jerome Schneider of Pimco. Next, this is ETF IQ on Bloomberg.
This is Bloomberg ETF IQ. I'm Matt Miller alongside Sonali, Basak.
And Eric Balchunas from Bloomberg Intelligence is back with us for today's drill down, where we're going to focus on one ETF here.
Sonali, thank you. Today we're looking at BLITZ with a Z, Pimco Ultra Short Government Active ETF. The name really tells you what you need to know here. Very, very short-term government debt or agencies it's going to invest in, and it's active. That's the key. You know Pimco is an active manager, so there you have the yes there. The fee is really low, 14 basis points. That kind of separates this. There's a couple cheaper, but this is really on the low end. 14 bips for active management, again, is on the cheaper side. Let's look at this sort of allocation here. And this is going to hold basically, look, it's very U.S. government. The duration is going to be very low and AAA. So again, a very, very safe kind of ultra short-term treasury ETF. But again, actively managed, trying to squeeze out maybe a little extra return there. Let's look at it versus SHV. This is an ultra short-term passive ETF from BlackRock, very popular. People use this all the time. My guess is this is going to try to eke out more return than that. So since it launched in June, it is beating it by 2 basis points, although they're very close. You can see the 2 lines here. So I think, look, Matt, Sonali, the returns are going to be important here, but also is the stability. This is really something to park cash in, I think. And with that low fee, that could attract some investors.
Thanks, Eric. We're going to talk more about this ETF with Jerome Schneider. He's the head of short-term portfolio management funding at Pimco. Thank you so much, Jerome, for joining us. If you take a look at bills, it's interesting because you've seen such incredible volatility at the short end of the curve. How important is it, and how do you choose what you will be investing in through this ETF, given the range of kind of repo to short-term rates?
It's a great question. I think when you take advantage of what we have come from and where we're going to, is that we're going to see relatively high short-term rates for a pretty long time. You know, we believe we're on the verge of a less synchronized world, perhaps one that's punctuated with a little bit of volatility. Investors have been looking for higher yielding and how to capture it, and they're doing that at the front end of the yield curve. So we've seen a good amount of demand in those capital preservation strategies, everywhere from owning T-bills directly to even being in money market funds. What BILZ, B-I-L-Z, specifically looks to do is to be an active manager in that space, looks to try to find optimization and relative value between those high-quality asset classes, being U.S. Treasuries, specifically T-bills in the front end, agencies, as well as looking at allocating to overnight repurchase agreements, which are collateralized by both government securities as well as U.S. Treasuries. What's important here is that even though there is a certain amount of high yield at the front end of the yield curve, there is actually some relative outperformance that can be had. And what we are seeking to do is bring that expertise, which Pimco has given to its clients in that short-term universe, into a high-quality, highly liquid capital preservation strategy, which can hopefully bring some outperformance to those traditional T-bill type of allocations over the medium term. And that's really the trade-off and the opportunities that we see here versus traditional money market and capital preservation strategies.
So how much outperformance are you looking to harness, Jerome? How much hot sauce do you put on these bills?
Yeah, there's not a lot of hot sauce in the sense that you're adding more risk. Again, it's focused on that capital preservation. What we're seeking to do, though, is getting out of the accounting mindset that money market funds have of buying and holding an asset and holding it to maturity, and instead looking at the relative value opportunities consistently between the complexes, between owning T-bills, which can trade either higher yields or lower yields to overnight repurchase agreements or benchmark rates like SOFR. These are opportunities which allow for total returns to actually be higher than you would typically earn in the traditional income sense in a money market fund. And so as a result, it could be a handful of basis points or it could be tens of basis points over the course of a cyclical horizon. And so when you're in an environment which is focused on capital preservation, uncertainty, and balancing that, the active approach is one that which brings a little bit more total return potential to our clients. And as a result, we're bringing this instrument to the broad-based investor populace.
So, Jerome, this product makes a lot of sense to me, especially for that fee. That's lower than most money market mutual funds. But money market mutual funds grew by about $600 billion in the first 2 quarters of this year. That's a ton of money. Do you think that institutional investors in particular overrate that fixed dollar NAV of a money market fund? What would you say to try to sort of peel some of those off into this fund?
Well, we think that investors have been really focused on that $1 NAV as a security, as a safety blanket. But we're also finding is that, with the evolution of the SEC's money market reforms, the focus on prime funds continuing to be in the spotlight going forward, that there's a continual rotation that will happen as we get the spotlight shifted from focusing on the credit risks and the liquidity risks within prime funds to being more conservative stance. But yet, there's a different opportunity set here. Yes, we're focusing on total return, but we're not maneuvering our eyes or shifting our eyes away from that capital preservation. So we just think there's a better way to be in the mindset of capturing the yields at the front end of the yield curve, in this environment. So we do think that over time, we're going to be able to differentiate ourselves in this relatively conservative landscape, but do so without sacrificing quality for sure.
Jerome, you mentioned at the beginning of this conversation that you expect things to potentially be choppy, that you expect it sounded like a higher for longer kind of situation. What are some of the things that may happen in the next couple of months that would keep this idea to be true?
What we're finding is that investors are really focused on how to create risk-adjusted returns, which make sense for uncertain economic outlook. And in that landscape, this is exactly where active management plays out. Having the resources to underwrite credit risk, looking at different, more diversified portfolio approaches. This is exactly what Pimco ETFs has done over the past few years in being very deliberate in evolving our platform to really focus on multi-sector strategies, active management approaches, where we think that there's not only better solutions which our clients can afford, but also mirror those with client demands. And that's why we have exactly done that, offered 6 new ETFs in the active management landscape over the past almost 18 months or so. From that perspective, though, I think what we have to do on a go-forward basis is look at the economic landscape. Sure, things like inflation are still a question mark. We have a Federal Reserve, which is going to be incredibly data dependent. And that data dependence translates to hopefully our clients having the optionality to maneuver and pivot and create a more balanced approach to their asset allocation resources. And that includes taking advantage of the higher yields across the yield curve, not just at the front end that we're highlighting in bills, but going out and beyond that in terms of our new products like P-Yield, PYLD, et cetera. And so from that perspective, we think that this uncertainty and the volatility which may emanate as we get later in the year from this uncertainty might create opportunities to be a little bit more flexible along the way.
Jerome, thanks so much for joining us. Pleasure having you here. Jerome Schneider there of Pimco talking to us about bills. I'm Matt Miller for Sonali, Basak, and Balchunas. This is Bloomberg.